everyone. Welcome back. Welcome to the Thursday edition of Trend Following Plus Nothing Ideologues Dangerous Cult Attack Session. Now, we've got a small group here. Probably everyone has been here before, but if you haven't been here, not in the attacking. I don't even think we're a real good cult either. Got too many smart people, too many of their own good opinions, and I certainly don't encourage you to take my opinions as the gospel and move on. Got to figure this stuff out for yourself, like I did. I just figured it out for myself, but I had a lot of good mentors and a lot of good advice along the way. But no spaces, no weekly spaces, so that's kind of a bummer. But anyways, I thought it would be good to start off by looking at the markets a little bit. We're not going to have Richard today. Not sure about Moritz, our two leaders. Yeah, so I guess the market's been pretty interesting this week with cocoa resurgence, dollar resurging a bit, I guess. I'm sort of mixed in the dollar. Bonds. Wow. And it's a very interesting trade, these bonds. There's so much talk about rates and people wanting to buy the bonds. It's just a typical good trend-following trend that continues to last for multiple years. Short is the only way to be, and if you got out, it didn't work out at all. And but there's just so much chatter about, and there's so many people wanting to be long. Just kind of funny. I guess that's how it works. You get these long-term trends, and you look back over the years and say, how in the world could anybody not be short that? I know it's a sad situation because they figure out a way to go against the trend. Yep. I'm trying to hold I won't do it here because I'm amongst friends, but I'm trying to not say too much about cocoa. You know what I mean? I don't want to say too much because I don't want to jinx it. But though, coming, I guess it peaked out, let's see here, around September 15th. And so then it had this brutal, gigantic days going lower every day, just a crash, and it didn't get shockingly close to my exit, but unfortunately, because it could have been nasty, and it can still be, of course. And then I just noticed that the ATR was creeping up, prior to that. So here we have the CTA vol managers selling their cocoa. Great trend, not much of a trend. It's a nice trend. It's a nice start. About a year old, I guess, and but really nothing, not close to NVIDIA or sugar. And then it just gets crushed day after day. And I'm thinking, I'm going to post this chart. I'm going to circle vol management and then CTA managed futures volatility management, especially if it goes back to the highs, because, then I'll have a big point. So we're not quite there, almost there. Another big day up today, but not quite there on the cocoa, but just between you and me, I'm really happy that cocoa hopefully will keep going and make that vol management, just like orange juice, vol management, continuing to peel off a great trend where you have nothing but massive embedded profit, no risk. Well, the risk of loss, but we have that covered because we're trading systems that we back tested that showed if you wanted to make the most amount of money, place your trailing stop in a certain place, and that place is going to be a place that doesn't get you out too quickly, lets those profits run. Shocking how far away that needs to be. What else is going on? Crypto, not too much. Still long. Oleg, you're waiting very patiently. How are you this morning?
Yes. I'm perfectly fine. I'm happy to be here as always, of course. No matter what is any other circumstances, no matter. So I'm really very happy. Hi, Jerry. And I have a very strange program issue that I don't see any participants of our 24 plus nothing dangerous cult attack session. So I don't see anybody. So hi to everyone, but I can't name you directly because I don't know who is here. So you are right, Jerry, that there are a lot of unpredictable moves, shocking moves, unpredictable moves, and we, as a trend followers, always, and as I remember, you said this a few years ago, and you said this many times, that in this unpredictable future, in this unpredictable, even today, we have always, we as trend followers, we have profit from it. We don't have shock from this, we have profit from this. And we are not discussing something that we are conventionally right, but we don't have enough predictionable factors and so on and so forth. The world is unpredictable. No, we have money because we have our 100% robust algorithm with a very good philosophy, very good backtest, with a huge amount of data, and all the evidence shows that our approach is really the best approach I have ever seen. I have tested, and I'm sure. So I love only 24. So let's get started. This week I was very impressed by conversation with Jerry. I don't remember the name of the show right now, but I was very impressed. It's on my Twitter page, Twitter profile already, my comments, so my notes. So I liked very much when Jerry said that I don't believe in discretion. I believe there are right ways to do things, wrong ways to do things. We should pursue those things. I don't think everything is great and equal. I never would say personally, oh, there is many ways to do things. You should just do what makes you feel good. I hear this all the time. It is the worst advice ever. And the second quote, if you can't stick to something when you lose money, get out of it. Don't even manage your own money, give it to someone else. You are not set up to do it mentally. So, I was very impressed, and I have told you many times, every time when I listen something with Jerry, I'm very impressed. And every time it is so, it even not depends on my, maybe it's it's objective. It's very objective. I see. If even I didn't know Jerry, I didn't know trend following, I would be impressed every time. I think so because it's great philosophy, great thoughts, great approach. So unfortunately, I don't see who the participants of our today's discussion, but let's get started. And I'm very happy, as always, to be here.
Thanks, Oleg. You should probably log off and come back because there are participants and you know some of them, so you're having some sort of issue, I guess. I'd never go back and listen to my podcast or spaces. I don't really want to hear myself talk. I want to move on to something else and pretend that I probably sounded better than I did. But I always have Oleg there to quote me, and I start laughing every time he was quoting me. Just then, I was just like laughing, like, "Why did I say that? What are you doing? Why are you reminding me, Oleg?" Anyways, um, thank you for being here. So Alp is here, and I don't know if Alp wants to speak, but Alp came to visit me, and we had a good time, short visit, and I hope he made it back safely to England. And Alp, we visited and we chatted, but Alp gave me a lot of good advice. So, see, this is what happens when you open yourself up to meet people and hang out. I got a lot of good advice from Alp. He's a very smart man, and he was really trying to help me work through some business ideas, and I appreciate that. So, Alp, how are you? How was your trip home?
Oh, well, actually, thanks a lot. I really enjoyed, the time there, Jerry. I really appreciate for your time. I've got good quotes, and I've taken a lot of notes at the back of having our conversation. So it is, there are a few things that you mentioned which are, quite eye opener for someone else like me. So that's I really appreciate that. Thanks a lot. Um, I was just thinking about, Jerry Parker was talking about the markets, and it's it's interesting, isn't it? The credit is making the most money at the moment. Think about that. And these bonds are just down like 50% from their highest highs. You know, if you look into TLT, or if you look into any long-term bonds like 30 years, 10 years, I mean, unbelievable. They are just 50% down, or maybe more than 50% at the moment, and really we don't see anyone else is actually shouting on Twitter, or any other social media. I think the who owns those bonds, possibly a lot of institutions, and they are not happy, their committees are not going well because they are long bonds, and so there's a bit of a problem for people who are just trading these things long only. And this is very interesting. It's very interesting. We would have heard a lot from, if the gold was down 50%, silver was down 50%, um, then, if S&P, if the equities would be down, 50%. Oh, yeah. Can you imagine? Um, Everyone would have been talking about it. But, the credit is down 50%. These bonds are down 50%. And it's all right. Trend followers are making money. Okay, that's good for us. But what about the rest of the folks? I mean, I'm listening a lot of contrarians in X, and they are saying, the bonds are going to go up next year. So everyone else, the majority of the people, are trading those bonds on a mean reversion. Really, why? Because they are getting the yield, so they are happy to hold it. They are happy to have this 5%. So, and they really cannot understand why they need to short the bonds anyhow, for a lot of people, and the ones that who shorted, they left it last year, and this year didn't go started well for the bond trading anyhow. So it's really a quite a small number of people are making money from those short bonds, and no one else is actually talking a lot about it. So this forum is an excellent place to talk about. Yeah, short bonds are making a lot of money. So I hope you're short the bonds, US bonds, EU bonds, especially the longer term bonds like 10 years, 30 years, 50-year bonds are really making a lot of meaningful money. So yeah, I say trend following works. It's just like magic. At the moment in my portfolio, credit is making money, one thing, and of course the US dollar is also making money. I'm not quite sure whether long-term models have just triggered long dollar bets yet, but my short-term portfolio, oh yeah, I'm short pounds, short euro, short um, Japanese yen against dollar. So basically, long dollar exposure is making a lot of money as well. So these are the two main trades, and the rest of it is just sleeping. There's nothing much happening. The commodities, you know, I'm not very happy from what the commodities is doing at the moment, and then the crypto is flat, and then um, there's not much happening. You know, Apart from, I would say, the credits and the USD, but it's good. So yeah, I mean, I think things started to move, and this year has been one of those years that it is highly educational for a new trader like myself. So I'm almost about to make 2 years in trading, and at some point the crypto worked. In January, crypto worked. In June, crypto worked. So there are 2 months crypto worked in my systems, and then there are 2 months stocks work very nicely, like June and July. All right. There are 2 months credit is working, like September and October. So this year might crash someone else with, who has a naive approach to markets, you know. And that's why for a new trader like myself, it has been highly educational. One asset class has worked, then it stopped working. Then the other asset class has worked, then stopped working. Then the third one has worked and then stopped working. It's unbelievable. 2023. I'm making a Bible out of this year. It has been so much fun, and I'm glad that I'm able to learn from experienced traders and Jerry Parker from this call. It has been highly valuable and educational for me, actually. But it's all fun and games. Thanks a lot, guys.
Yeah, you bring up some good points there. One is that rather than trying to guess the what's and do a relative strength type of approach and trend following, I just trade all those bonds, right? You cannot name one I don't trade. I found one that no one knew existed. There you go. That's what I do. And that was the 3-year note. Someone told me about it. Somehow I figured it out. I got the 3-year note. Anyways, rather than guessing, because initially in the first leg down, it was pretty much the bigger moves were the short-term bank bills, bankers' acceptances, Swiss. I forgot what the Swiss is called. It changed its name, etc. Then it's now, of course, it has switched to the long term. So I didn't do a relative strength to try to get in, load up on the short terms at the breakout. How would I have known that? And then I'll now switch to the longer term. I just trade them all independently for the diversification, which is minimal, but now you're getting a little bit of diversification. Plus, you're getting rewarded for trading them all and trading the long term ones as well. So that's pretty interesting. There's this cliche out there that people talk about, which is, when things go on sale on the stock market, it's the only place where no one wants to buy. And I feel like that I'm exactly that same way. My attitude about buying things, in real life is I want to try to get a good low price, But my attitude about the market is just to be trend. But people in the markets, especially depending upon what that market is, they will wait for a bargain. Now we won't, but there's some like bonds. They're kind of like, oh well, if I hold it, I won't lose money because it'll mature at par if you buy it at par, I guess. And then it's this juicy 5% or so, right? Without any mention of inflation, zero mention. I'm locking in these yields. Well, dude, the only reason it's at 5% is because inflation is much higher than it was when bonds were close to 0%, 1%, right? I mean, this is the news, right? So you have these smart people, very incredibly smart. I mean, just the smartest, talking about locking in yields without regard to the inflation rate. And another thing that I keep posting on Twitter, I troll people on this subject, kind of. I don't even know what trolling means, but I think I'm trolling. And that is now CTAs are a great investment because you get that 5% return right on top. We're up 5% to begin the year. And this is free money. It's magic. It's the magical free money because now we're back to earning a solid return on our 80% of the money we have in treasuries because our margin is usually 10 to 20%. However, and I kind of knew this to be true. I must have researched it, obviously. And then I chat GPT'd it the other day, and I posted to chat GPT. I said, hey, chat GPT, is the contango, the amount that you pay more for a futures contract, correlated to interest rates? And ChatGPT confirmed that yes, you are getting the 5%, but now your contango is much higher. Is it 5%? I don't know. It could be 5, 4, could be 6, 7. I don't really know. It's probably different. And then sometimes you have a backwardization market where you don't pay a contango. However, usually in a futures market, you're going to pay more for the futures than you would the cash for the very fact that you can invest the balance, right? And you've got other costs associated. So this is another thing I don't really understand about smart people. I'm out there, I'm going to post this every single time I see someone talking about free money with this interest rate. It's not free. It's not magic. We have inflation. We have contangos. You're locking in yields, but you're also, the Fed has locked in inflation. Cordura, are you?
And Cherry, do you have? Hey, how are you? Hope you're doing great. What do you think? Do you have any opinion about the other bet that many people are thinking about, which is the Treasury inflation protected securities, the TIPS? Because many people are talking about that positive real yield that they're getting today for something like 5 years, etc. I have my own thoughts on that, but I don't know if you trade them or if you have any opinion on that one.
I'm doing well. Thanks for asking. Well, I don't understand the tips very well. I honestly don't understand them. Um, and But I trade them. Like, I'm one of the few CTAs that trade tips because I trade securities, and tips don't have a futures contract. So I go to the ETF market, and there is at least one, I think, BlackRock ETF.
Yeah, the TIP.
Right. And so I trade that. And then I trade there's another one, not sure if it's BlackRock. It's a short term tip. And so I trade both of those. And I've been, short and long those this year. I was short the tips all the way down as inflation was rearing its head. And now I think I went long the short term tip. And at the same time, I was mostly short the long term tip. So I don't understand inflation protection not working, i.e., being long and losing during inflation. So I think, once a long, long time ago, I don't know, 10 years or so, I was invested a big amount in my personal money in like a Vanguard tip mutual fund. And I said, okay, I'm just going to invest in this mutual fund. And it felt like just something you put your money in and it's just going to be wonderful. If inflation comes, you're covered. You don't have to look at it. So the next thing I knew, I didn't pay attention to the chart. And I acted like I didn't know how it worked. And I still don't. I'm like, I don't really know how these things work. It's sort of complicated. I read what they say. So this is so safe. I don't have to worry about it. And then I looked up and my investment was kind of crashing. I had made some money, but then the trend put my typical breakout parameters up on the chart. And I noticed that, wow, this thing is really going lower from a trend following point of view. How is this even possible? So I said to myself, how dumb can you be? Dude, you don't know anything about anything. All you know is the trend. So just, and people who say they know what's going to happen in these markets, they're frequently wrong as well. So what you need to do is just follow these trends. And so I immediately got out and I'm like, how dumb can I be? I pretended I didn't know anything, pretended I knew something. Then I was shocked that I didn't know anything. And this is how I approach markets for 40 years. And it's coming up on 40. I'm going to start saying 40 because the turtle class started in December of 83. And we started trading January the 2nd, 84. So I'm going ahead and saying that I'm a 40-year guy now. So enlighten me as to how someone could get a short signal, and make a lot of money in tips over the past few years, shorting them during a period of inflation. I have no idea how this happened.
Yeah, they are kind of difficult to grasp, but they are very easy, as you said, very easy to sell. Much easier than, for example, trend following, and that was one big selling product last year, and many people lost money on that. And I think that the main issue are two. First is it's a constant maturity thing, right? If there was a future contract or a
I can
fund.
give an explanation if you want. I think you have to understand the mutual fund that you're investing in. Can I ask two questions? The first one was the mutual fund, was it like Franklin Templeton type mutual fund, or was it a mutual fund that came from BlackRock or something like that?
I think it was Vanguard.
Right. So what they invest in is actually options on the underlying. So I'll give you some examples of why this happens. Imagine you're trying to invest in mortgage-backed securities, right? Which back before the crash and all this other stuff and the rise in interest rates was very common for pension funds. So what PIMCO and JP Morgan and others would come, they all had the same name called the PIMCO Income Fund. It was like 40% mortgage-backed securities at a 2 to 5 year. Then it was like et cetera, of some kind of tranche that was like a 10-year. And they would say, you're investing in mortgage-backed securities, right? And then you look at the mortgage-backed security, for example, and it's going up in value. But the income fund, which apparently does do this, is going down in value on behalf of those mortgage-backed securities. That's why they're able to charge very low fees. The options are actually losing value due to liquidity issues and all sorts of stuff that occurs. This, in terms of the reflection on the price, is that. So that's one issue. And again, there's a lot of reasons why they do it. It's in order to make it more liquid. Back in the day, Jerry, I'm sure you remember, fees for these types of products were were much higher than today, relatively high back in the day. So at they were sometimes 200 basis points. Do you remember what the fees were? The free mutual fund was 100 basis points.
Oh God, I mean that sounds high, doesn't it? Given Vanguard, it probably wouldn't have been 100 basis points.
Maybe 20 basis points, correct?
Yeah, maybe.
So how do they achieve that? Not through scales, through options. If it was 200 basis points, which exists, then they invest in the actual asset. So who does that? Smaller firms like HSBC or there's a Hong Kong one that I just used called CP something, and their difference in fees are completely different. And people say, well, your fee, because this matters. So for example, Jerry, let's say you're a buy-side asset manager, right? And you get offered products all the time. You would think the fees which are lower are always better, correct? You believe that it's going to be easier to get in. You don't have to make as much in return to still make a return because the fees issue. Because like the issue with this is that if the fees are high, you need to make, let's say if the fees are 200 basis points, you need to make obviously far above 200 basis points to justify that to clients on why you got those kinds of funds, right? But if it's just 20 basis points, which is now a very typical kind of that type of fee for those types of institutions, then it becomes like almost tradable, correct? So because they use options instead, the actual options market on different tranches of those mortgage-backed securities are really decided by intraday trading between hedge funds that exist in like New York mostly for just for mortgage-backed securities. So you said you did mutual funds on tips, correct?
Mutual funds, yeah, mutual fund on tips, exactly.
That would mostly just be PIMCO and other buy-side bond funds trading between each other, deciding the market. They say it is something, but it is not. A much more extreme example would be like the UBS Active China Fund, which is a mutual fund to invest in China. But when you look at the underlying, it's not really China. Some of it's in China, some of it's not in China. Some of these are just kind of large companies, some of these are like kind of small companies. And then they present and discuss and say, if you invest in this, you're investing in China, which is not really true. But the same argument could also be made about this. All those mutual funds investing in AI, when you look at the underlying, they're the same underlyings as companies that invest, for example, in data. It's like Amazon, Microsoft, blah, 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 blah. And they're using options. And then so as you said, there's the contango risk, That's one. So, for example, you remember that the oil ETF had contango risk back in 2019. That's the reason why it was completely like weird versus the actual underlying oil price. And then, of course, it just rolls. So if you're investing anything with commodities or even with fixed income products, there's a roll factor, right? So those are reasons why. But they're never very transparent about the exact reason why when you call them up.
Oh, good. Thank you for that. You know,
I'd also like to add a final one. You know, there was a good example of the Bitcoin ETF. And why is it that the Bitcoin ETF is actually has a lower value than the actual price of Bitcoin on exchanges? And the reason was that when you lock in the Bitcoin ETF, it's traded below the par of the actual Bitcoin. Because there's redemption issues, right? When you add all those things together, they create a lack of liquidity, which reduces the buy side upward pressure, which makes it below par compared to the underlying asset if it was truly an underlying asset. Because it's options, it does it even more. It's like multipliers of low par redemption value versus the underlying. Does that make sense? Or am I...
right. Yeah. So I think you're just kind of helping me make my point, which is go with the trend on these things, and don't try to ask too many questions. You know, we don't even know how they're doing it, what the underlying is. We think we're getting some the exposure.
Well, you know, it's how can you ask questions when the answers rarely come back as the truth? You know, if you would ask, for example, PIMCO income fund back in the day, like, am I really investing mortgage-backed securities? And they'd be like, yes. And then you'd ask more questions. They themselves don't know the answer. There's two worlds out there, and there's a reason why. There is the research side that comes up with the research that shows clients what this is, and then there's the actual prime brokerage side that that packages the products to make the actual asset work, right? That they package and sell. The two don't really talk a lot to each other. Not supposed to, really.
Good morning, Josh. How are you today?
I'm fantastic. Thank you for asking. What an interesting view from the outer. Thank you. The outer view.
Yeah.
I do have some jokes. Some trading jokes. The cocoa trades is melting in my mouth. I'm squeezing profits from the OJ trade. And I'm peeling off something from the banana trade, which I don't even know exists, but still is funny. Getting the humor quote out of the way, the trend following experience for me is a tiny retail voyager, experimenter, discoverer has been just illuminative because it spills over into life, as Oleg always reminds us, with great glee and internationality as I speak from the East Coast U.S. But, you know, loose pants and, you know, the idea that I don't really know the future, those are profound and disruptive for me. And I've been closing collections of tranches, so to speak, in my Fidelity IRA, where, you know, I'm taking these other kinds of fundamental approaches or technical approaches. I've been cleaning up my trend following holdings and really staying with the big guys. Caveat, most of my money's at Jerry's mutual fund, and I've started a program not to trend follow the trend following, which we kind of settled last week, but to just kind of, not even the dollar cost average, but to regularly buy this, Jerry, you might have heard of it, I'm not sure, this trend following plus nothing, TFPN ETF, which, you know, I put in my bids at 25 and then sometime during the day it gets accepted. So I'm building a position there quite happily. I'll close with congratulations on being a 4-decade trend follower. Thanks, Jerry.
Yeah, thanks, Josh.
I didn't understand any of that.
Well, yeah, those jokes. You didn't understand the jokes, maybe, but they're pretty funny. I don't know if there's a banana out there either. I don't think there's a banana company.
There's not. There never was.
Yeah, I don't think there's a banana.
OJ though has been around for a while.
Yes.
The ones that people don't know about were originally onion futures. I used to be an onion futures trader. And that they got rid of that, unfortunately.
Yeah, so sad. So many tears. Too many tears.
Yeah, the everybody likes to bring up the onions because I think it had a big move or it went to zero. I think it went to zero. Onions was one of those things people bring up a lot.
Yeah, there was a cornering in history, a cornering of that market, I think.
I'm going to dig into my bag of tweets here. I think I bookmark a few. I like to bookmark when I can't. I need a, as you know, we need a. I don't like on Twitter. I can't like things, but I want to remember them. Oh, Andrew had a big post this week, very long, like 11. Yeah, it's 11 out of 11. I'm looking at 11 out of 11. He talks about the model portfolios, the 60/40. You know, something big changed 2 years ago with 60/40. It became very correlated. They both went down. Now things have changed, and I guess my whole point is things can change back. You know, if I think that there's nothing to say that 60/40 can't start working really well again, and and we could get back into a situation where you don't need the type of diversification that trend followers, CTAs offer. This is not a situation where now the light's been turned on and CTAs have clear sailing forever. We have to remind ourselves that anything can happen. If you can dream it up, if you can think about it in the markets, it's going to happen. It can happen. It probably has happened to some degree in some market somewhere. So I think people need to refine their systems, make them better, increase their diversification, trade stocks, add markets, and do all they can because, you know, what's going to play havoc with our business and our strategy. It may not be 60/40 next time. So we conquered 60/40. Okay, maybe it's never going to come back, whatever. Who makes these predictions anyways? I mean, why? I don't like that sort of talk, you know. Who knows? Super cycle in commodities. You know, I'll profit from a super cycle, but why talk about it? I mean, it doesn't make any sense. You're setting people up to like anticipate, you know, some sort of, you don't need to do that. I mean, if it hits the breakout, we're short a lot of commodities now. We can make a lot of money in being short for a period, and then we'll get long again. But I don't like these throwing out these predictions and expectations. What was funny about all these traders moving to Abu Dhabi. I tweeted about that. That was pretty humorous. Abu Dhabi used to be, you know, the biggest client for everyone in managed futures back in the 2000s. They came in and dominated and gave everybody hundreds and hundreds of millions of dollars to manage to their credit, and it just was fantastic. I mean, they were managed futures in the 2000s. Um, I think it was the 2000s. Oh, it could have been the 90s as well, late 90s, 2000s. They were managed futures, billions of dollars given to CTAs, the best client ever, and just phenomenal guys. And so then it all kind of changed. They wanted to do things in a more sophisticated, enlightened way. So they got rid of a lot of their CTAs, and then I think they did some stuff in house. And anyways, it just been a big transformation, invaded by New Yorkers and Wall Street types to kind of help them navigate the future. And now it's become a destination spot for hedge funds. And then this article was kind of funny. It was talking about all the reasons to move to Abu Dhabi. There's a lot of hedge fund people there. The weather, well, it's kind of hot there, 120 degrees, it said in the article. Then it sort of the last sentence was, and also the sovereign wealth funds are there with all those billions to give out to the hedge funds. Yeah, you think? You think that might be a pretty good reason for people to go to Abu Dhabi? But it's a great place, and the people there are marvelous, wonderful people. I had so much fun there. The nicest people, some of the nicest people on the planet. Yeah, I thought that was a pretty good place to be. I love visiting there. It was so much fun, but really I'm sure a lot of people know about this, but Trust me, these were the smartest guys investing in all these CTAs, making so much money. And sometimes when I would go over there and visit, they would pull me aside and say, Jerry, our managed futures portfolio that we manage inside of this big sovereign wealth fund is the best part of the portfolio. It's the best performing part. So I think they got wore out by the middle or the beginning of the lost decade with managed futures, so they kind of lessened their exposure. But boy, what a great time that was for them and for us to be a part of all of that and meet those people and enjoy all of those great markets together. And it was just fantastic.
Jerry, can I ask you a question? Did it bother you at the time, that kind of replication wave that came in places like Abu Dhabi and also in Canadian pension funds? Because many of those guys thought that it was an easy strategy to replicate compared to other more obscure kind of strategies that Wall Street sold to them. So they tried to do that. Many did it with good results. For example, some Canadian pension funds, etc. But at the time, was that a worry for the industry, or it didn't matter?
Well, it was a bummer that they made that decision, and their sort of replication was not the Andrew replication, but the Corey replication. Corey's replication is half Andrew's, and then half trying to come up with systems that would be similar to, I guess, SocGen 20, and trade those systems. So Andrew has to wait for the return and put the positions on that would replicate the recent return, where Corey does half of that, and then the other half of his replication is he trades systems that he thinks. So he says this combination is better for him, and so basically back in March, when Andrew's replication started to underperform dramatically. Well, I think it was March. Could have been a little before March too. That Andrew, it was so critical, because the markets were moving so violently that the lag in Andrew's updating of his positions was sort of blamed for his underperformance. Whereas with the way that Corey does, he calls it, I think, bottom up and top down. I think bottom up is the actual systems that he's created. That's going to generate trades on day one, and that's kind of one of the benefits, I guess, rather than waiting for the return to be posted and then updating your positions to replicate those returns on a weekly basis. So they were not doing that. They were just thinking they could duplicate the trades that we were doing on a daily basis. And I think to some degree, when you're a manager and in a business and you get yourself in that situation where the clients don't really think that you're adding that much value, that they can do it themselves, that's kind of a place you don't want to be. And as you can imagine, we're hearing this, I can do what you do. It was brutal. I was in those meetings. Just imagine face to face someone saying something like that. You're in a situation, and then you're thinking, wait a second, I'm thinking it. You have the lowest fees on the planet, and now you're unhappy with that. And so you want your fees to be, you want to hire someone to do my job. So to some degree, and then I think they went on to do that and implement that strategy for all of us who, that's the downside of preaching trend following plus nothing. Well, then I think I can do it. And then people who are preaching trend following plus a lot of stuff, you can't do what I do because I'm a quant and it's a lot of complex algorithms, which we poo-poo. A lot of those guys and girls stayed and they didn't get the boot. So I think, though, that another better solution would have been, let's get rid of most of those fees. Let's go ahead and pretend like it's an ETF and pay us really, really small fees, because you probably won't be able to duplicate with your group all of the knowledge and experience, regardless of how simple the trend following systems are perceived to be. The better hedge might be, let's keep all these CTAs that have made us all this money, and this has been their profession for these years. And let's just pay them a lot less. And so, but I do think that they probably realized that was, you're not going to be able to have the kind of performance that you had with people who were not as knowledgeable and experienced as we were. But that's just my guess. They may have been really really a good performance from those guys who watched our trades and probably chronicled our trades and figured out, oh, I see what they're doing. I managed account.
Yeah, and I guess there is a lot of money managed like that, right? I think there is a lot of money inside those institutions managed as trade followers.
Right, and it would be interesting to see how well they do. And but I don't know if I'll have that information to compare. Now we have these ETFs, and you can see the positions. I guess one way to overwhelm that is to just trade so many markets. And but anyways, it is a bummer, and hopefully they were successful and they're happy.
I just wanted to say that many of the things that we talked about today has to do with mean reversion and the way we as people see the market. And I think that that's the default position for all of us, being mean reverters. I think that trend following is something hard to do. And, when you see something falling, it grabs your attention and you think that it will come back because it did in the past. And that's one of the things that I guess makes trend following work, because it's a natural to all of us. I mean, if you watch what Jimmy said about that ETF, that Bitcoin ETF that is trading always at a discount, you see that and your brain immediately says, that thing has to go back. So why not revert that? And I think that happens with bonds and with the equities, etc. So I think that's something so common, that doing this and common way of trading is good, in the same way that doing the natural things helps you in your life on any item.
Oh, also I wanted to mention, we posted this, but I'm going to go to Australia, and we're going to meet up with Richard and Moritz Hayden and Adam in Sydney in November. And so I don't know if we have any Australian listeners or whatever, but I'm looking forward to getting down there with those guys and talking to Richard face to face. And this, there are some good questions I have for him, and hopefully we'll have some good back and forth and meet some of his friends. And so I'm looking forward to going on that trip to Australia. If anybody has any suggestions on fun things to do near Sydney, Melbourne, in those areas, let me know. We have a good travel agent, but if I haven't been to Australia in probably 20 years, so I'm looking forward to visiting down there with those guys. And you could always show up. You could be like Marcel and fly in from somewhere else and hang out.
Jerry, can I ask you a question? You spoke about Contango and the way that you manage the idle money, so to speak. Do you aspire to invest 100% of the money in treasuries or something like that? I guess it's just treasuries, or do you need to have a minimum of 10% or 20% of cash? And if so, do you guys take some kind of risk on that, or you just leave them as a custodian or something like that, or do you just manage to invest 100% of it, all of it?
That's a good question. Cash is a position, cash is king, and the CTAs are going to have, a large percentage of the cash, of a large percentage of the money invested in the fund in treasuries, in cash. And so I recommend, we've always managed that money very conservatively and just put it in treasuries, sometimes yielding, almost nothing, and now yielding a lot more, 4 to 5. So for us, cash is really not a position. We have this portfolio with all these markets. We're using leverage, and the portfolio exposure kind of expands and shrinks based upon the trends. If we have these big trends and all the markets are trending, then we have lots of positions, and still 80% of the money in cash in treasuries because it's the excess margin. And then as we start getting out of those trends and we've made money, then our portfolio starts to shrink. We have fewer positions on, and then we'll have more cash. Maybe now we're up to 90% of our assets that are in treasuries because the margin is less. So cash is really not a position for us. We're taking on positions and we're earning this interest, which we must earn. It's just a break even because the interest is paying for the contango that we're paying in the futures markets and in the cash markets where we use leverage. We have to pay that interest expense. So for the CTA, it's really, cash is really not a position. Your cash being a position or having some money in cash, whatever the cliches are, this is what people say in the traditional investing where they don't use leverage. We always have these opinions, which is our trends and our breakouts and our breakdowns. And then I have my position set up to where I can, if every market in my portfolio, all 350 were in a trend and some of them weren't flat, but they were all trending, I could afford to take all of those positions. Now, that's never happened, and it's unlikely to happen. But the CTA portfolio with the leverage, the exposure and the positions kind of expand and contract all the time, depending upon the trends.
Yeah, and many people, as you said, believe it's kind of a magical thing. Like for example, if you buy a buy and hold position with futures on the S&P, you get the S&P return plus the cash, which is not the case. That's something you just need to kind of break even.
That's right. I've been thinking about it this way. If you bought the S&P ETF with your $1 million worth in it's an ETF, you put $1 million in it. You could also buy the S&P future, $1 million worth of that. The only way to get the same profit that you would get in the ETF would be to include the interest income. It's an armed market, so there is no free money. That interest income just makes you whole. And then in a period where their interest rates are close to zero, the price of the S&P future is about the same as the price of the ETF.
Yeah, but isn't there a drag on the implementation using futures? Meaning, if you need to put, say, for example, you put an unleveraged position on the S&P using both either ETF or futures. If you need some excess margin to be in cash, earning 0%, then you will have less return. All the other things equal. I know they're not equal because there is dividend risk, etc. But I mean, if you need to put some kind of cash and not treasuries, etc., you will have a small drag, right?
I don't think I understood all of that.
No, meaning that if you, for example, you build an unleveraged position, you try to replicate the SPY but with futures, right? So you go buy the contract and you invest all your money, all the cash in treasuries, but you need a small amount of excess cash to be cash. So every day they put money back and forth of that depending on the P&L. That money that sits in cash, which is a small amount, isn't dragging the overall return.
Oh, I see what you're saying. Well, that's really more of an administrative thing as it relates to your broker and who your broker is. There's lots of differences with brokers. And And you can imagine a $1 billion client, like a sovereign wealth fund, can strike a deal with a broker where they don't have to worry about have that cash sitting there idle, or if it's sitting there, they get interest on it. So I'm sure you strike all kinds of deals with, dependent upon your size. And yeah, I'm not sure that's a thing, but I guess it's definitely possible for.
Yeah, I guess so. That there is a thing. It's about how you negotiate things with whoever is between you and the market.
Yeah, and we have a great broker, and we have very low commissions and very low borrowing fees and portfolio margining. And then I read about what other people are charging to short stocks or borrow, and I'm just horrified. So there's a lot of differences out there in the brokers.
Jerry, when you're talking about the brokers, the industry standard is pretty much like interactive brokers in terms of the costs. They advertise themselves as the lowest cost brokers. So when you say your broker is a low cost, has your team looked into a comparison against interactive brokers by any chance? Do you have any idea where your costs in relation to what interactive brokers do? Thanks.
Yeah, I mean, I think that's part of compliance is to do those research studies about the brokers and what's possible and how good your broker is in those particular areas.
Now, what is happening is, in terms of the brokers, so there are many considerations with those brokers, and one of them is, of course, the algo trading. There are lots of conventional brokers that you can do trading discretionary basis, but there's only a handful of those brokers that actually you can go ahead and do algo trading, and you can do algo trading through APIs. So you have to code an API, a software that can actually connect to the broker's servers and calculate your position, send orders and whatnot. So there is a lot happening within those brokers, and who can provide technology to automate the trading facilities. It's very interesting. Sometimes the cheapest broker doesn't provide the best technology, or you want to get the best technology, but you don't get the best prices. So it's just an additional layer on choosing a broker, basically. But you want your broker to be listed in a stock exchange for sure, for transparency. So that's one of the things that I almost always look into it, whether a broker is listed, and also whether it is compatible with automation, and API trading is the second, is one of the questions that I always ask, and there are many other questions for sure, but these are pretty important for me. Thank you.
Anybody else want to make some statements or ask a question?
Jerry, it's Julian. I'm from Brisbane, so I look forward to hearing where you're going in Sydney.
Yeah, I don't know what I'm doing there. I'll consult my itinerary, but I'm going to some nice places outside of Sydney, but I don't remember where I'm going to be in Sydney. I know we're going to have the get together at Bibo Wine Bar and Thursday, the 16th of November. So yeah, I need to get my act together.
The poster is I popped it on the Twitter feed, the X feed for today's spaces.
Okay, thank you.
cut this one short. I've got some other things I need to do. It's my grandson's birthday, and he is waking up, and I need to wish him a happy birthday. So I think next week's is going to be a different time as well. So be on the lookout for that. It may be next Thursday as well. I'll give you plenty of notice. So be on the lookout for a time change for probably not next Friday, 7 a.m. Eastern time. Thanks for being here, everyone. See you next week.